How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. So, the topic of unrealized losses in bank bond portfolios has been a big issue since the banking crisis of early 2022, when Silicon Valley Bank and Signature Bank failed and then led to other issues with other banks. And this whole concept of unrealized losses, the losses that banks could potentially have in their bond portfolios on their balance sheets, created a lot of issues around the topic of liquidity, bank liquidity. Like, in other words, if you did run into a crisis and you needed liquidity fast, i.e., you had deposits going out the door, you had to get liquidity for the bank. One thing a bank can do very quickly is sell its investments. But if you have to sell those investments at a steep loss to get some liquidity in the door, ultimately how that's going to impact your balance sheet in a very negative way. So we went through a very aggressive, one of the most aggressive Fed rate cycle, interest rate tightening cycles in the Fed's history from 2022 to 2023. And then the Fed basically plateaued that cycle. And now, which basically the increasing in interest rates as quickly as the Fed did it is what basically put banks' bond portfolios in the hole, creating this massive mess, as it were, from the interest rate increases. Now that the things have stabilized, the Fed is now pivoting and going into a rate reduction cycle. So what is that going to ultimately do now to banks' bond portfolios and their investments, as it were? So there was a great article that was out this week from S&P Global Market Intelligence, and I wanted to take a look at this because, maybe we can find some answers here on what could potentially happen. So what does this say? This says lower interest rates have supported stronger values in banks' deeply underwater bond portfolios and could spur more repositioning activity in the next few quarters. So the take here is the Federal Reserve's pivot to decrease interest rates could lead to more structuring of bank bond portfolios, as the capital hit associated with those transactions will not be as large. Those actions might still require a bank to raise capital, and there have been a number of institutions in the last month that have repositioned their bond portfolios while attracting outside capital. Even with declines in rates, many institutions likely will opt to wait for their portfolios to season and avoid taking the capital hit associated with a lost trade, but others will see the opportunity to improve their future streams through incremental restructuring. Now, that being said, a couple of things we have to address here. There are a number of banks over the last year that have basically taken the hit to reposition their bond portfolios. Did they take a hit to earnings in a short term, like a bad quarter? Yes, they have. But in taking those hits, they repositioned their bond portfolios and their earnings potential going forward, as well as any potential liquidity issues, have been addressed, and now they're okay and looking a lot better going forward. So, one of the thoughts that I always had was basically like, I thought it was better to just kind of take the hit, get it over with, and move on. Now, some of the banks had very large hits, and the way that they covered those large hits was to do certain things. You've seen certain strategies take place. For example, a number of banks have sold their insurance divisions because the premiums were very attractive, and so they took the hit on their bond portfolios, took the loss there, but then they sold their insurance division and basically used the profit from that to offset the loss. The other thing you've seen banks doing is basically doing what's called a sale leaseback of their retail branches. They basically sold, they take the hit on their bond portfolio, do sale leasebacks on some of their branches, take the profit earned from the sale of the real estate and use that to cover their bond losses. So we've seen banks basically do certain things out there and look at certain strategies to address this issue. A lot of banks, however, have basically said, you know what? We're just going to place everything instead of the AF. So you have two categories. You have AFS, available for sale, and you have HTM, held to maturity. A lot of banks have taken the strategy of, okay, we're just going to take all of the AFS and we're going to dump it into HTM, held to maturity, and we're just going to hold this thing to maturity. Now, if banks do that, that is fine. Eventually, they will get to the mature point, and at which point the banks will get their principal back with some interest, and they won't lose any money, and that's all fine. So that is certainly a possibility. The question always becomes, well, what if you have something happen before you get to that point? That's the problem. What happens if you have a crisis or if something comes up that forces you to sell those bonds and now at a steep discount, and you have to recognize that loss? You have to take that loss in order to get the liquidity and to address the issue. So it becomes kind of a double whammy. So you've already got a problem, and now that problem is further compounded by the fact that you now have to liquidate these assets at a loss. That's the real worry here. That's the thing that is at the heart of the issue here. It's what regulators have major concern with. But banks don't really have, if you've got this problem, and if it's a big problem, unfortunately, you don't really have a lot of wiggle room there. You either have to sell and take the hit, or you have to find some way to offset that hit, i.e. with some of the strategies like selling your insurance division or selling some of your branches, at least the real estate, and working some other way to basically find the money to offset this potential loss for when you restructure the portfolio. But now, banks are hoping there might be some light at the end of the tunnel here with the Federal Reserve basically reducing interest rates, could make the loss or potential loss a lot less cumbersome, and therefore now they might be willing to actually bite the bullet, take a much smaller loss, reposition the bond portfolio, and move on. Let's keep kind of going here. So lower rates could drive more repositioning activity. So, and here's the kind of the key chart here. So you can see from 2021 wasn't really much of an issue. Then we get into 22, and here's where the interest rates start going up by the Fed and basically tanked all these bond portfolios. So what happened here? What ultimately happened was most banks basically thought that the Federal Reserve was not going to increase interest rates, and therefore they went long on their bond holdings. They went very 5 years, 10 years. They went out long on their bond holdings. So when interest rates went up, those bond holdings went underwater, and that's that. In certain respects, that might be a little bit of an oversimplification, but I'm trying to say this in layman's terms and just kind of lay it out here for people. So, so bond portfolio restructurings were relatively muted in the second quarter as the positions remained deeply underwater in the period, but transaction activity could pick up in the third quarter due to a sharp decline in rates as the yields on the 2-year and 5-year treasuries each rose 34 basis points in the second quarter. The values of bonds held by banks declined. With those increases, the regulatory capital hit associated with lost trades rose in the period. The tide turned, however, in the third quarter, and the intermediate rate plunged as the market saw the Fed's eventual pivot to lower rates on the horizon. The yield on 2-year treasuries fell 79 basis points in the third quarter, while the yield on the 5-year treasury declined 66 basis points in the period. However, I would just note that as far as the 10-year goes, one of the things the big blip, if anybody watched the BND Strategy Room episode last night, the live stream, I talked a lot about how the 10-year treasury rate is actually going up and why that's happening. And, some of the treasury rates may be going up. So there might be basically a window here that you could take advantage of this. It's a tight window, but we'll see what happens. So, but then it goes on to say, lower rates bolstered values in banks' bond portfolios, and some institutions took advantage of the move to reposition their investment portfolios. For instance, Rhinebeck Bancorp, Midwest One Financial Group, and Amerit Bancorp Inc. announced restructurings on their bond portfolios or unveiled plans to pursue such a transaction. In those cases, the banks are selling low-yielding securities and reinvesting the proceeds into high-yielding bonds or loans available in the marketplace today. Midwest One and Amerit also announced common stock offerings to alleviate the capital hit associated with the lost trade. So common stock offerings, in other words, they're going to raise capital. Absent sales of securities, changes in values of banks available for sale, AFS portfolios, do not impact banks' regulatory capital, save for large banks classified as U.S. global systemically important banks, the GSIBs, otherwise, i.e. the 4 biggest banks in the country. Banks have to mark their AFS portfolios on a quarterly basis, and those marks are captured in accumulated other comprehensive income, otherwise known as AOCI, and impact tangible common equity. Since portfolios remain underwater, that mark has negatively impacted tangible book value since the first quarter of 2022. The hit to tangible book value rose at the end of the second quarter, with institutions including U.S. commercial banks, savings banks, and savings and loan associations that file GAAP financials reporting $101 billion in unrealized losses in their AFS portfolio compared to $106 billion in unrealized losses in the prior quarter. So it's come down a little bit, but this also gets to the heart of the next big issue, and that is mergers and acquisitions, M&A activity in banking. So the M&A activity, a big reason why that has been muted this year is because of this. The AOCI, which does what? It impacts tangible common equity, which hurts banks' book values. It negatively impacts their book value, which means that hurts the sale price on which a bank can sell itself to another bank. And what happens from an accounting standpoint? So if you have basically unrealized losses on your bank bond portfolio and you go to sell the bank, guess what happens? You have to now sell those and realize those losses. So, which thus would, hits the tangible book value. And it's become a big issue, and it's part of the reason why bank M&A activity has been so muted this year. I'm going to be doing another episode here this week on M&A. I'm going to kind of give an update on M&A, so check that out. I'm also going to go through an interesting M&A transaction that just occurred, or was just announced rather, in Pennsylvania. So again, check that episode out when it comes out. So here's the quarter over quarter change in AFS and HTM securities per asset group. So I thought this was some interesting charts here, so we can look at banks with less than 100 billion in assets, and you can see that the change is it was a lot of change here in second quarter 2023, third quarter 2023, but then the changes have become less muted throughout this year. This is banks between 100 billion and 700 billion in assets, and again, kind of the same trend. And then greater than 700 billion assets, a little bit more activity here amongst the biggest banks in the country. So a little bit more activity here amongst the biggest banks, and we'll see why in just a minute. So, but here we go. But banks hesitant to invest further out on the yield curve. So bank regulators have focused on the negative impact of AOCI on bank capital and the impact that underwater bond portfolios have on banks' access to liquidity. Against that backdrop, banks kept their powder dry for the last few quarters and have put less cash to work in the bond market. Banks have also been hesitant to reach further out on the yield curve and extend duration in their portfolios, even though the industry has expected rates to decline for some times. Banks have been reticent to grow their held-to-maturity securities portfolios, which some institutions had used to mitigate the impact from AOCI by parking larger portions of long-term bonds, often seen as loan surrogates, in those portfolios. Those positions remain significantly underwater in the second quarter. Some banks, particularly the nation's largest institutions, relied heavily on the HTME designation since changes in AOCI impact tangible book value. So there you have it right there. What's going on. So basically banks are very hesitant to go out long on the yield curve. They want to stay short because they even though rates are coming down, there's still a lot of uncertainty as to what's going to happen. And we got HTMA security trends at U.S. banks. So this is like held to maturity in like trillions, and then available for sale in trillions. So you can kind of see, still relatively even here to a certain extent. For large banks classified as GSIBs, changes in AOCI also can impact their regulatory capital. So held-to-maturity securities represented a median of 59.1% of total securities among those institutions at the end of the second quarter, down notably from 62.5% in the first quarter and 67.6% a year early. Under the proposed capital rules dubbed the Basel III Endgame, changes in AOCI will also impact regulatory capital of banks with more than 100 billion in assets. So unrealized losses in HTM portfolios at institutions that file GAAP financials totaled 269.2 billion in the second quarter of 2024, up slightly from the 265 billion in the prior quarter. Since the Fed began its tightening cycle in early 2022, the investment community has examined the ratio of loans plus HTM securities to deposits at a given bank to see how many deposits are tied up in less liquid assets. The ratio is also effectively a measure of duration risk on bank balance sheets, given that HTM portfolios were built when rates were low and have served as a drag on bank earnings streams. So, and then given the negative review from the investment and regulatory community, banks likely will continue to look at HTM designations with greater skepticism. Some banks have taken advantage of lower rates to reposition their investment portfolios and more likely will follow, but few institutions have actively sought to extend duration before rates move lower. More bank managers continue to look at their bond portfolio as sources of liquidity rather than drivers of earnings. So, and then here we have at the end of the article here, top U.S. banks by HTM securities in the second quarter. And you can see the four largest banks. Implied unrealized loss or gain, obviously Bank of America, $110 billion. JP Morgan Chase, $29 billion. Citigroup, $20 billion. Wells Fargo, $41 billion. Charles Schwab, $14 billion. US Bank Corp, $12 billion. Morgan Stanley, $12 billion. Truist, $12 billion. I'm sorry, 10 billion. I'm sorry, Morgan Stanley, 10 billion, Truist, 10 billion. Now, important thing to note, I mean, the top four banks in the country all have $1 trillion balance sheets. So, JP Morgan, do they want to lose $29 million on, on implied losses? No. Or 29 billion? No, certainly not. That would dramatically hurt their earnings. I mean, you're talking about a company that probably generates about, probably about 25 billion a year in earnings. So that would basically probably wipe out about a year's worth of earnings for them, which would, not big, but obviously Bank of America, much bigger issue, $110 billion potential loss. I mean, that's a huge number for them. And then obviously for your smaller banks like Truist, you can understand like Truist just sold their investment, their business insurance unit. They basically also just, sold off a bunch of bonds and tried to reposition a bunch of things. So they're working on trying to get their issue resolved. But obviously, so I think the key point here at the end here is that it's a big issue. I mean, I think this, and again, I go back to this chart right here. This is the big, this is the big illustration here. If you can see how big the problem is. And, obviously the Fed reducing rates could help this a lot, but if the treasuries, there are other reasons that I have explained in other videos, like the treasuries rates could go up. And if treasury rates go up, that could reduce the window here, or the window of opportunity to try to do something. So I think, again, end of this year, we're coming upon the last couple months of this year, going into next year. I think, 2025 is going to be a very interesting ride for a lot of things. We'll see who the president is next year. We'll see how the economy is going at the early part next year. We'll see how aggressive the Fed gets with rate cuts. But this is not an issue that's going to go away anytime soon. Even if the Fed really reduces rates next year, that's not going to wipe this away. It's not going to get rid of it. So like I said, we'll continue to see what's going on. Banks, I believe, are going to continue to just be very cautious. They're not going to want to go out long on the yield curve. As long as this remains an issue, it will have an effect on bank M&A activity. So we'll see. We'll have to see what's going on. But hopefully, this was a really good update. Hopefully, people got some good information out of this. And, we'll continue to monitor this issue as we go along. So, okay, I'll wrap up with, remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, as I always enjoy getting back to everybody. what else was going to say? Please check out some of the other content on the channel. If you didn't get a chance to check out the Strategy Room live stream from last night, please go check that out. I will have other episodes posting throughout the week. There should be an episode every day, Monday, Tuesday, Wednesday, Thursday. And then next Friday, I'll be back to my normal live stream time, Friday night at 7 p.m. On YouTube. Come follow, check it out. Hopefully you'll like it. But but until then, I'll see everybody soon. Have a great one. Thanks a lot.